恭喜发财, ladies and gentlemen. Ang Pao Toto Lai. This we welcome the year of the wooden dragon. Now, ladies and gentlemen, the dragon is an auspicious, powerful, or enduring animal in the Chinese zodiac. So, how does you do position yourself to trade profitably this year in the year of the dragon, as we have always done in the last few years? In our this week's video, we're going to share a few secrets with you. And yes, look at that. We are going to cover a few things. How have stocks performed in the last 3 dragon years? And what lessons they behold for this current dragon year? 2, what to look for S-REITs in this current transformative year. Yes, ladies and gentlemen, the dragon normally bolts and bring in and sweep in with a powerful transformation, be it the stock market, be it your personal relationship, or be it personal and political affairs. Now, it is up to you to be positioned to either swim or be sung with the dragon. In both cases today, we'll share with you how to swim with the dragon, and secondly, how to avoid being sung or sanko with the dragon. Thirdly, we are going to talk about how to swim in the dragon, and in this respect, I want to show you how does one train oneself physically, mentally, and physiologically, to actually ride an explosive S-REIT market if and when the explosive S-REIT market takes off this particular year. Fourthly, let's look at some of the S-REITs results so far and what does it tell you for the shrewd and smart investor like yourself. And last but not least, we want to share with you how not to sink with the dragon. But as usual, ladies and gentlemen, we take a couple of hours, in fact up to 10 hours, to prepare a video like this week in, week out for you. So give us a smart subscribe button, tell your friends about us, and actually subscribe and enjoy our video week in, week out. Now let's look back at the first dragon year, the last of the last 3. Now this was actually in 1988. Now in 1988, ladies and gentlemen, when I just started my career as a stock analyst and went on to hit the stockbroking arms of a couple of stockbroking companies in Singapore, as well as have a 3-year working stint at Wall Street. Now this is what I learned. Now way back in 1988, ladies and gentlemen, yes, I know some of you are not even born yet. Now 1980 was a transformative year because the year before was 1987, and 1987, on the 19th of October, in that particular day, stock markets lost a woeful 22.6% on that particular day. Can you just imagine it? Now you would imagine that 1987 would turn out to be a terrible bad year for stocks, but reality, ladies and gentlemen, is a no. Stocks recovered very quickly to end the year while still negative, but not as bad. And in 1988, we were roaring. That's the beauty about stock markets. They change quickly, so you must put yourself in a position to think flexibly, how to respond quickly for changing events, as what the dragon will do. Now the second one, that is the year 2000. Now year 2000 actually saw the climax, the epitome and the huge maximum point reached on Nasdaq. I think the level reached was 5034, as you can see from the orange red dot, that typifies and exemplifies the top of the market, in the dot-com bubble. Now the previous bubble was in 1989, during when the Nikkei actually hit 38,900. So in the dot-com bubble, ladies and gentlemen, we suffered for the next 1.5 years. So again, this time around, the dragon year of 2000 actually brought a strong market to an end. So it's the reverse of what you saw in 1988 rather. And what about 2012? Ladies and gentlemen, 2012, again, the reverse happened. That means Dobale, right? What happened was that in 2010, 2011, we had a European global financial crisis. So we had actually terms like the PIGS, which actually talks about Portugal, Italy, Greece and Spain, companies, or rather the corporate bonds, rather the country bonds, sovereign bonds, almost defaulting. Greece uh, national bond actually went up to as high as 30%, and that was one of the first national bond I bought. And guess what? By 2012, things have started to turn around, things have improved, and you can see again the dragon year brings about a transformation. So what about for this year, ladies and gentlemen? You may be asked, yes, ladies and gentlemen, the Yap family, that's my beautiful wife there, my two little naughty little kids, welcome you into this year of the wooden dragon. And what does the wooden dragon means for you, the sharp and smart REIT investor? Well, stay on and find out. But before that, subscribe to our channel, tell your friends about it, and love our channel. Give us a bao up. So, ladies and gentlemen, how to train this transformative here, right? And how to swim with the dragons. Well, look at this chart, ladies and gentlemen. You can see that when when the market last rebounded the last time around, coming up from the interest rates upcycle from 2015 right up to the last date of 20th December 2018, when the Federal Reserve stopped increasing interest rates. You can see we had a huge run up, as you can see from the orange line. Right thereafter, you can see while the market continues trunches up, there are mini pullbacks exemplified by the red line. So if you read and you see the red pullback lines, there are actually 1, 2, 3, 4, 5 along the way. So, ladies and gentlemen, first thing about market rallies is that, especially on S-REITs, is that it's not going to be just one straight line up. There will be moments in which the dragon pull you back. Okay, but if you actually go on and swim the dragon, you notice that essentially you will reach higher highs. As you can see, the second half of the rally is typified by very stable up channel return. So this means, therefore, if you want to ride and swim the dragon, ladies and gentlemen, you have to fortify yourself, train yourself physically, make yourself strong and mentally. And how do you do it? Let me suggest this particular exercise for you. But of course, do try it only when you're fully confident, and make sure that you are fully capable of it before you do it. Try this. It's really very good. It's therapeutic. It's transformative for your body, for your mind, and enjoy it. So, ladies and gentlemen, to swim with the dragons, essentially prepare yourself so that you're always very agile and flexible. And one of the best ways to do this, the explosive Superman dragon push-up. Let me show you how it's done. Yes, ladies and gentlemen, that was the explosive push up, that you are able to do. Well, at least I was able to do it, and I started like you, unable to do it. But train yourself every day because it involves a whole myriad of other exercises to prepare yourself. Now, same therefore, if you want to be a sharp, smart, and sagacious REIT investor, not only must you know your REITs well, you must know the entry point, must know when's the exit point, and you must know when the management of a REIT is talking nonsense, because you don't want to be falling into those nonsense, right? Essentially, you also want to be at the coops and the ability to pick out the timing right before the REIT actually surges. Okay, so let's look at essentially what the corporate results have yielded so far. you can see that so far, and not surprisingly, only 5 REITs that have reported out of the 20 REITs have reported positive DPU. Man, ladies and gentlemen, yeah, but this is again, you have been following us closely, as I've mentioned in my Business Times front page of 17th of, or rather 22nd of January. This is what I said. And let me read out what they quoted me. Veteran REIT investor and chairman of GCP Global, Gabriel Yap, believes S-REIT's earnings will be muted at best and disastrous at worst. Yes, ladies and gentlemen, as you look at the table here, you can see that practically, right, most of the REITs reported negative DPU. In fact, the second page shows you some of the worst. Can you imagine Manulife, 100% drop in the DPU? That's of course because they stopped paying DPU. Then investors, well, literally, or people who are more like stuck in the REIT, why continue to be stuck in the REIT when they don't pay you anything at all? Then you have Suntec REIT actually down almost 20% when you would have thought that essentially the portfolio of stable, good office and Suntec retail assets in Suntec prominently, in downtown should be able to deliver steady returns, right? No, that's not the case, ladies and gentlemen, right? Then what is the case, ladies and gentlemen? You may say, well, of course, in our class on the 23rd of March, we're going to touch on the nuances, the intricacies, and what are we and how are we be able to position ourselves to be able to foretell earnings and DPU changes of REITs before they actually happened, right? So essentially, uh, do join us for the class, because we're going to touch in that. And so moving on, ladies and gentlemen, in this week's video, our last point: how not to sing with the dragon. Remember, the dragon is a very powerful British animal. Okay, it flams its fire, and you must ride with the fire, right? But there are certain reads, which basically evidently would have given you signals that they can't. In fact, they will be sung with the dragon. And what are these? Yeah. Like in GCP Global Investment classes, we like to talk about, empirical data that actually emanates from the prices of the REITs that tell us a story because it tells us how the market view the REIT, not what the manager think, okay? Not what so noted analysts or think. What we try to do is to delve into the market data because these are the ones that give us the intelligentsia of what and how they feel the market will do. And one of the key traits that we have taught at GCP Global Investment classes is this: that once a share or a REIT price have dropped 50%, probability of it recovering is very, very difficult. In fact, it's almost zero. In fact, the reverse is true. Once a S-REIT has dropped 50% in terms of share price, the likelihood of another 50% drop is even stronger. Let us show you, with clear empirical evidence. Let me just start with the first one, lipo malls. Now, first and foremost, of course, in our GCP Global Investment classes, we cater to high net worth individuals. We actually have who's who in the REIT market in Asia joining us. We actually have, we cater to a lot of specialized medical specialists who join us online from Thailand and Malaysia in particular, to attend our classes. We also have index fund managers as well as family offices. So do join us on our next class on 23rd of March, where we talk in detail on things like this. Now let's go back to Lipo Malls. Now Lipo Malls, ladies and gentlemen, from its peak at 80 cents, yes, you may be thinking, oh my goodness, are you sure it was 80 cents? Now it's not even 8 cents. Yes, when it was listed way back in 2006, it actually fell down to 40 cents. So by 2017, when it hit 40 cents, you notice that, it didn't take long. It took just 1, 2, 3 years, yes, from 2017 right down to 2020. The share price collapsed another 50%. That is from 40 cents down to 20 cents. And as you know, ladies and gentlemen, from 2020, you notice if we don't show this chart anymore, Why? Because since then, that means 4 years now, from 2020 right up to 2024, it's been 4 years, and Liverpool malls can't even close above 20 cents at all. In fact, it is actually below 10 cents for the longest period, right? So once again, empirical data shows and tells you that once a REIT has collapsed 50% in price, the likelihood of recovery is almost zero. In fact, the reverse is true. That is, it is likely to fall even further by 50, 60, 70%. Or what? Well, this is something we discuss in detail in our GCP Global Investment class. Let's move on to the second one. Now this was actually our Manulife REIT, which essentially I talk in my book, which was written 6 years ago now. This is the hot seller, same equivalent in Chinese. There's actually bestseller for REITs in China, Hong Kong, Macau, and the US. So this 6 years ago, I was able already to predict on Manulife, and you can see that essentially the share price actually collapsed, from 80, 90 cents down to 40 cents in uh, in November of 2022. And then what happens after that? Well, you may say it took less than a year for it to fall even further by another 50%. That is from 40 cents down to 20 cents. So from November of 2022 right up to July of 2023, it fell another 50%. That is a whopping 40 cents down to 20 cents. And after falling 20 cents, what happened? Since last year up to now, coming to 1 year, the share price has not recovered to 20 cents, let alone 10 cents. So once again, ladies and gentlemen, once a REIT has fallen 50%, the likelihood of a rebound is almost flat. So don't waste your time looking at this REIT, right? In fact, with the S&P market moving up so quickly, so sharply, registering new highs, you'll notice that if you're caught in this rut, you wouldn't have energy. You wouldn't have the mentality to be looking at those markets when AI, artificial intelligence, is powering the likes of Google, the likes of Microsoft, the likes of Nvidia share prices. And this is an area that you should be in.